A buyer may agree to pay $500,000 for a home, but the lender still asks a separate question. Is the property worth enough to support the loan? That is where a home appraisal comes in. An appraisal is an independent estimate of value, usually ordered for mortgage approval. The appraiser is not there to decide whether the buyer loves the house. Their job is to estimate market value based on evidence. They look at the property, recent comparable sales, location, condition, size, features, and market behavior. The opinion must be supported, not guessed. Comparable sales are central. These are similar homes that recently sold nearby. A 3-bedroom house is usually compared with other 3-bedroom homes, not luxury villas or tiny apartments. The appraiser adjusts for differences such as square footage, lot size, upgrades, garage, view, age, and condition. Timing matters. A sale from last month may say more than a sale from 2 years ago. Markets can change quickly when interest rates rise, inventory shifts, or buyer demand cools. Appraisers try to use recent data because value is tied to current market conditions, not old hopes. Condition can change the result. 2 homes may have the same layout, but one has a new roof, updated kitchen, clean systems, and well-maintained flooring. The other has leaks, old wiring, and visible damage. Buyers may see potential. Lenders focus on current collateral value. Location is not just the city name. A home near transport, schools, parks, or employment centers may compare differently from a similar home beside heavy noise or limited access. Even within one neighborhood, street position, view, traffic, and future development can affect value. The appraisal protects the lender. If the buyer stops paying and the lender must recover money through the property, the lender wants confidence that the home supports the loan amount. The appraisal is not mainly a buyer protection tool, although buyers can learn from it. An appraisal gap happens when the appraised value comes in below the agreed purchase price. If a buyer offers $500,000 and the appraisal says $470,000, the lender may base the loan on the lower value. That can create a funding problem at closing. There are several ways to handle a low appraisal. The seller can reduce the price. The buyer can bring more cash. Both sides can renegotiate. The buyer may cancel if the contract allows it. In competitive markets, some buyers agree to cover appraisal gaps, but that increases cash risk. Homeowners refinancing also face appraisals. The lender wants to know how much equity exists. If the value is lower than expected, the refinance terms may change or approval may fail. A homeowner may feel the home is worth more because of memories and effort, but the lender needs market evidence. Appraisals are not the same as inspections. An inspection looks for physical problems: plumbing, roof, electrical, moisture, pests, safety issues. An appraisal estimates value. An appraiser may notice obvious condition issues, but they are not doing the same detailed technical review as a home inspector. Appraisals are also different from online estimates. Online tools use available data and algorithms. They may be helpful as a rough starting point, but they often miss condition, renovations, unusual layouts, views, noise, or local micro-market details. A human appraisal can adjust for information the algorithm cannot see. Sellers can prepare by giving useful information, not pressure. A list of upgrades, permits, recent improvements, and relevant comparable sales may help. Trying to influence or intimidate the appraiser is not appropriate. The best support is accurate documentation about the property. Buyers should not assume the contract price proves value. In a bidding war, emotion and scarcity can push offers above what recent sales support. A buyer may still decide the home is worth it personally, but the lender may not finance the full gap. Personal value and appraised value can differ. Appraisers make adjustments, but adjustments are not perfect math. If one comparable home has a renovated kitchen and the subject home does not, the appraiser estimates how the market values that difference. The number comes from judgment supported by data. That is why appraisals can vary between professionals. If an appraisal seems wrong, there may be a reconsideration process. The buyer, seller, or agent can submit better comparable sales or point out factual errors, such as incorrect square footage or missed upgrades. Disagreeing is not enough. The challenge needs evidence. The appraisal can influence negotiations. A low value may cool an aggressive seller. A value at or above price may reassure the lender. But the appraisal is one piece of the transaction. Financing, inspection, title, insurance, and buyer cash still have to line up before closing. A home appraisal works by translating a property into supported market value. It takes the house out of pure emotion and compares it with evidence from similar sales. For buyers, sellers, and homeowners, the key is simple. The market may like your property, but the loan depends on what the appraisal can support. The appraiser may use more than one approach. For ordinary homes, comparable sales usually matter most. For rental property, income can matter more. For unique properties, replacement cost may be considered. The method depends on what kind of property is being valued and how buyers normally price it. Appraisal independence is important. Lenders, agents, buyers, and sellers are not supposed to pressure the appraiser into a preferred number. The value opinion has to stand on evidence. If the number were simply negotiated, the appraisal would stop protecting the lending decision. Renovations do not always return their full cost in value. A homeowner may spend $50,000 on upgrades and expect the appraisal to rise by the same amount. The market may not agree. Buyers pay for usefulness, condition, and desirability, not the owner's receipt total. Appraisals can be stressful because they arrive late in the deal. The buyer may already be emotionally committed. The seller may already be planning the move. If value comes in low, the deal suddenly has to be repaired with money, negotiation, or a contract exit. For sellers, pricing close to evidence reduces appraisal risk. A high list price may attract attention, but if comparable sales do not support it, financing may become difficult. A strong offer is only strong if the buyer can close under the lender's rules. For buyers, the appraisal is a reality check on borrowed money. It does not tell you whether the home is perfect. It tells the lender whether the agreed price is supported enough for the loan. That distinction helps buyers respond calmly if the number comes in lower than expected. For example, a buyer may offer more because the house feels perfect, but the appraiser still compares it with recent nearby sales. A seller may believe a renovation should add its full cost to the value, while the market may only reward part of it. Appraisals can be frustrating because they replace personal attachment with supported evidence. A buyer can prepare emotionally by separating two questions. What is this home worth to me, and what value will the lender accept as support for the loan? Those answers may be different. When they are different, the buyer needs cash, negotiation, or the discipline to walk away.